Hi there, welcome back to this investment in shares series and particularly around this theme of a new bull market. Now I've had several requests to provide some more background on what was presented in videos 1 and 2. So this is the third installment in that series. So in video 1, just a quick recap, I addressed the question of why now? Why is now a good time for a bull market to be unfolding? And the primary reason, of course, is the quantitative easing that's happened out of the central banks over recent weeks, and the consequence of that is the removal of fear about Europe collapsing. And I made the point that it will be selective in terms of the particular stocks that are going to do the best. Video 2, I then looked at the concept of price earnings expansion and contraction and how that can affect the price of a share and how we can use that knowledge to profit. Now in this third video, I'm going to expand on the detail about why the bull market in selected stocks looks to be a very high probability event to me, and also look at the impact on the Australian market itself. So just a little bit more detail first off. In terms of the global debt, I guess the question that a lot of people are asking is who's going to pay it back? And it's pretty obvious that neither America or the European countries can pay it back, certainly not now, and it's pretty hard to see how they're going to be able to do that in the future. The debt's just too big and there's not enough growth drivers that are going to allow them to do that. And they don't have any real money left. All they can do is print funny money, so they can't really stimulate growth through the means that they may have been able to do 30, 40, 50 years ago. So to me, the inevitable outcome is one of two things, or possibly a combination of both. The first is that taxpayers are going to have to assume the debts through privatization of institutions that go bust. So private banks, hedge funds, whatever you like, go broke, they're deemed too big to fail, the government nationalizes them, and guess who? The taxpayer ends up paying for it in the end. The other alternative is that governments can seek to inflate away the debt effectively by stealth. And they've done a fair bit of that already over the last 10 or 20 years. And the latter, the inflation away by stealth, is really the more politically acceptable alternative. And that's why I'm as good as convinced that that's what we're going to see. Now let's have a look at America. The consequences of their unlimited quantitative easing is going to be a lower US dollar. They're trying to do that because they want to boost export competitiveness. There's no question about that. And Bernanke's aim is to get unemployment down and spending up. So trying to get a wealth effect, trying to drive the property market, trying to drive the stock market higher so that people just feel better about things and spend. Whether that has a lasting impact on economic growth is highly questionable, but we'll see in time. And obviously that will be a boost to commodity prices and stock prices if the US dollar heads lower. Now one of the really key things for me as a good sign of what's going on in America in the stock market is that the Russell 2000, which is the small and mid-cap end of the American market, has proven to be very resilient, and it's not very far off its all-time highs. So that really tells you a lot about the momentum in the US market. Now turning to China, this leadership change, which should occur in October, which happens every 5 years, is really clouding the picture. China has a huge capacity to inflate if they choose to, but the problem is we have no way of knowing whether they will or whether they won't. So it's a really big question mark. And this is a chart of the Shanghai Composite Index going back to 2004. And you can see we had a massive rise. We then got a huge fall during the GFC. But really since then there was a bit of a snapback, but nothing like other countries around the world. And in the last 12 months or so you can see that it's really started to tail off, and there is definitely a trend down. You can see the red moving average line is heading down and the value of the index is below it. So quite clearly in downtrend, which is not a great sign. Now let's turn to Europe. The economic growth prospects in Europe, to me, don't look all that terrific. The austerity measures, if they are followed through on, are going to severely limit growth at the best. The stimulus that the ECB has recently done was necessary to calm the markets and to allow them to function. If they hadn't done that, I think the continued pressure on Spanish and Italian bond yields, so in other words the government's inability to fund their operations, would have had very, very severe consequences. Now, stocks in Europe, and we'll have a look at a couple of different sections of Europe in a minute, but stocks had been priced for a financial meltdown. So we're now getting a big rebound because people are now confident that there's not going to be a financial meltdown. And if Europe abandons some of the austerity measures that they've been pursuing and are still talking about, all it's going to do is add further to global inflation. This is the DAX index. Now you can see the spikes in the middle are the highs around 2007, 2008 before we went into the GFC. You can see Germany, the stock market rebounded very, very quickly. We had a bit of a sell-off last year, but now it's rebounding again quite strongly and is not that far off its all-time highs. So that tells you how things are going in Germany. This chart is the S&P 350 shares. So these are the 350 biggest shares in Europe, not just Germany. Now it's a completely different story because this takes into account obviously large companies in Italy and Spain and France and other places as well. So you can see it's really just starting to turn up now. We're starting to see the moving average, the red line, starting to flatten out, and the price is now poking up above it. So we're in the very early stages of a recovery in the stock market on a broader Europe picture. Now let's turn to Australia. What's the impact on us? Now the pricing peak of the mining boom is over. I think everyone probably acknowledges that that's the case. We're not going to see iron ore back at $200 a tonne. We're not going to see coal at $350 a tonne again. So I think the pricing peak has passed. A lot of people are saying, okay, well that's the end of the mining boom, but to me the volume peak is probably not over. The signs are that volumes may continue to rise, which obviously partially offsets the lower pricing. Now the Australian dollar will probably continue to strengthen unless the Reserve Bank cuts interest rates further. And they can't really afford to let the Australian dollar strengthen further because it's killing the competitiveness of some sections of our economy. We've got overseas fund flows coming into government bonds. That's other central banks, and it's also large hedge funds. We've also got overseas fund flows into our higher yielding major stocks, such as the banks and Telstra, for instance. So it gets down to very specific stock selection in Australia is critical. I don't believe the majors, the banks and Telstra and BHP and Rio, are going to see a lot of capital growth because there's so many uncertainties surrounding China. But there will be a small number of great businesses that are well established and have got a terrific financial record already, that have been paying robust dividends, and I believe that robust dividend growth is set to continue in the future. Now some of those are overvalued right now. They're great businesses, but they're just too expensive, and a couple are still good value. So there certainly is some opportunities there in the Australian market, but the process that you really are best served following is to buy the dips. That's really crucial in being able to get above average returns, particularly from both capital gain point of view and also from a dividend growth point of view. Now a key point is that any assessment of the market or a specific company is dynamic. So what is valid today may not be valid in 3 months' time or 6 months' time. So no one should really take a stock tip in isolation and expect to make money consistently. It's just not going to happen. Yet subconsciously I know that that's what many people want because I've worked with literally thousands of people over the years. Now there's a classic example in Leighton Holdings, which was one of our best financial performers for much of this decade. And as a consequence of that terrific financial performance, they saw a very, very strong share price growth. But 2 years ago that all changed. So I just want to take you through this example of latents to show you just how much things can change and how you should never take the current situation for granted. So you can identify 4 significant opportunity phases over the last 7 or 8 years in latents, and we'll have a look at a chart of this in a minute. Phase A was when you had an opportunity to buy the bull market phase when the company's share price was rising strongly because the company was in great financial shape. But inevitably the price gets overheated, and that happened in late 2007, just before the crash, and we moved into phase B, which was an opportunity, if you know what you're doing as a trader, to either short sell the crash and make a lot of money, or alternatively just step aside from the market altogether. But certainly if you'd bought latents in the high $50 or even $60 area, then you would have suffered very, very badly, yet that's when most people would have been buying latents. Price then moved into phase C, which was really the recovery from the end of the GFC. The company still appeared to be going fairly well, so it recovered from oversold and basically doubled its price in a fairly short period of time. And then we move forward into the final phase that we're in at the moment, which is the company's financial performance has basically fallen apart, and so it's provided another short selling opportunity. So here's the chart showing this. You can see phase A, which was a very strong move from around $12, got up to 62, but anyone that was paying more than about 45 really doesn't understand how financial markets work. We then got the big phase B section down through the GFC. We then had a recovery from around $16, got back to about 40, and now you can see we're in phase D, where the company's fortunes have certainly changed quite considerably. So just a really clear example of how markets are dynamic and how circumstances change, and you should never ever take a piece of information and think that that will apply into the future without limit. Now, just a quick reminder, this is general advice only in this video. So what should you do in future if you want to be a successful trader or investor? The key thing is, do not operate just on stock tips from anywhere, especially if you really don't know the source. You need to understand the basics so that you can make some value judgments yourself. You can just ask yourself some questions to be able to tell the difference between fact and fiction. And you need to source some kind of startup, I'll call it a package, but you need to source something that encompasses some training that's appropriate for the information that you need, that will provide you with some very high-level interactive support, because everybody has different questions and different needs. So that kind of interactive support is really critical. And to also provide you with information guidance until you understand the market enough to be able to make those selections yourself. So I've put together some free video training to show you how to make money through shares on an ongoing basis. It's a step-by-step process that's quite straightforward when someone shows you how. So go to our website and fill out the form, and I'll be happy to send that information to you. Cheers.